India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Last trading day of the week. It's a Friday morning. We are coming to you live as always from the CNBC-TV18 and this is Bazaar Morning Call. I can't say too much to track from overnight because overnight US markets were shut, but there is a lot lined up as we look ahead into a Friday session and of course into the weekend as well. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning,
Good morning.
folks. I guess we three here in the studio have managed to bring out a little bit of cheerful color, though it's not been a very cheerful week for the market. It's been crunching and it's been tough. And I don't know, apart from the markets, are you ready to work 90 days a week, Nigel?
No.
I think that's gotten a fair amount of discussion online and offline as well, and we'll spend some time talking about it. But besides that, I think we have a market to deal with, and it's not been an easy market.
On certain weeks, so I'll be close to 90.
That's different, but as a rule,
No.
Maybe there's a lot to think about. Maybe there's a much bigger, wider social debate that's needed because, yes, I mean, we're a very different economy with very different realities in terms of commutes, in terms of life, in terms of work-life balance. So I think this is a wide open public debate. It's not going to settle anytime soon.
All right, well, let's just kick it off with what you need to know as far as the trading action is concerned, right? I mean, picking up, of course, from last night. Last night, US was absent. You had US equity markets which were shut, bond markets shut early, so there isn't that indicative handoff in terms of what the start here could be. So in a way, a bit of a vacuum this morning. Dollar index, I mean, currency and rates market, of course, I mean, you had some indication, dollar about near the 109.2 odd levels. So there was a tad higher, touch higher. Yields, I mean, the 10-year was absolutely flat. Actually, intraday, it went up 5 basis points. But again, I mean, the market shut early, so I'm not sure how much of that you can take. 2-year was down, so for what it's worth. Lots of Fed speakers, multitude of Fed speakers, at least 4 of them, and all of them kind of generally pointing in the direction that maybe we need to go slow as far as interest rate cuts are concerned. Slower rate cuts. It's been the theme when we started this year. I said, well, last time, 15 days post the FOMC meeting, that's been the big macro driving point, and I think is getting more and more credence in that sense. Oil prices, I mean, Wednesday we were up 1%, yesterday we were down 1%, this morning as we come back we're up 1.5%, so not very much by way of change actually, point to point, $77 and change. The big data point later tonight is going to be the US monthly jobs number, which I think is the key risk. Now, the consensus is at about 165,000 jobs, but I've seen estimates as low as 120, 130. It'll be interesting if we do get a significantly changed number as compared to the consensus, what the market does, because the general view is hardened that, the economy is much better. Trump is going to make it better. It's America first, etc. So you don't need that many rate cuts. I mean, the rate cuts expectations for 2025 have been whittled down to 2 cuts. That's it, about 40, 45 basis points or so. So, will this be able to change some of that? It'll have to be a big difference compared to expectations. 4.2 is the unemployment rate consensus out there. Just to sort of tie in the levels here, we saw, of course, a weakness once again here in India, especially in the broader market. And 2 days now, the market low has been on the Nifty 23,500 or so. It's been sort of so far defended, and that's the reason why I think on the downside, this is the level to hold, 23,460 to 23,500, right? 23,460 is nothing but the 31st of December low. 23,500 is basically where the market's kind of bounced off from for the last 2 sessions. Breaking this will confirm further downside slightly. It's been generally, I mean, the mood's been sideways. Price action has been sideways to down as well. Now, immediate resistance for the Nifty, 23,640. That is nothing but the hourly average, 40-hourly exponential moving average on the way higher. Again, just about 100 points away. The Bank Nifty has, again, broken all key support levels. By the way, it's also, and we'll have to show it chartically, but it's also broken a head and shoulders pattern, which doesn't bode too well. Downside target here comes in at about 48,950. We're at about 49,500. So it's about, 1.5%, 2% away. The immediate resistance for the Nifty Bank stands at about 50,127. That is the 40-hourly exponential average, as we put out for the Nifty as well. So these are immediate levels which the market needs to come up above for some semblance of optimism to really creep back in. Remember, TCS last night reported numbers, and we'll talk more about that in a bit from now. But I have to say, and you'll hear from the management, the commentary, not the numbers themselves for the third quarter, the commentary from them perhaps seeming a little better. Gift Nifty will come up on your screen, and that should give you a sense of how we're likely to start this morning. And that's about, another 60-point cut? I mean, these are the knocks, they keep on coming, and they have through the most part of the last fortnight or so. 23,584 is the indication. Surabhi.
Absolutely. 2% down on the Nifty so far this week, almost 4% down on the mid-cap index so far this week. It has not been easy by any stretch. Challenging start to 2025 for sure. Now, the setup this morning is no better because most of the Asian markets are trending on the downside, barring Hong Kong. Hong Kong is the only market, and this, absolutely flat indications in Taiwan. Barring these two, most of the other larger markets like Japan are down, Singapore, Australia, most of these markets are trading down. The spotlight continues to be on the non-farm payrolls report, which comes out later when the U.S. market action resumes. And just for reference, the number in November was about 155,000. The number in November, beg your pardon, was 227,000. And the expectation this time is ranging between 155 to about 160, 165 in terms of the job additions. So slowing down in the number of jobs added from November. That's largely the construct. The other important development is China, and it relates to the China bond market. We must keep a track on this as well. The PBOC this morning has said that it will stop buying Chinese government bonds temporarily. And why is that? Because bond yields in China have been tumbling. This is because of the low inflation to deflationary trends that are seeping in. Remember, we spoke about the producer price index, which continues to be in deflationary territory in China, and consumer prices are simply not rising. And bond yields have been tumbling. The PBOC feels that perhaps there's a bit of a bubble building up. So it has said that till the demand-supply situation in government bonds in China kind of balances out, it will stay away from the market. So that was an important development. Because of that, there was some green on the China markets, but even that is fizzling out. Let's come back home here. Another massive day of FPI selling. Look at the numbers. I mean, you've got over 7,000 crores of selling in from foreign investors. Once again, it's domestic investors to the rescue. But these numbers are large and you simply can't ignore them. Big, big numbers there. Domestic institutions buying almost 7,600 crores, while foreigners have sold off stocks almost worth 7,200 crores. Now, we've been testing the weekly low, which is around 23,500. Twice we've done that. Two successive days. Now, will that low be broken? We don't know. Last week's low then comes in question, which was 23,460. So levels are coming and going with no meaningful rebound. Can today be any different? The bulls will definitely hope for that. And the hope is coming in from TCS. And this is exactly what I was mentioning yesterday as well. The fact that Q3 is going to be weak is in the price. The stock is down 10% in the month of December to price that in. But will the stock show enough signs of life to start an uptrade just on the basis of the commentary? That's the most critical question. The numbers, dollar revenue is down 1.7%, which is more than what was anticipated. Constant currency revenue is flat, which is also a little lower than our poll. The margin picture is good. It's exactly in line with what Rima was telling us. There's a 40 basis points margin improvement. 24.5 is where the number is coming at. But more importantly, the commentary, and you'll hear more of it. What is the TCS management saying? The CEO is saying that there is improvement in discretionary demand. There is some improvement in sentiment that they're noticing. And that calendar year 25 should definitely be better than calendar year 24. So will there be an uptrade, at least a trade, based on this commentary? We'll find out. The other number that came out, Tata Elxsi, was weak. Revenue was down a little bit, and the margins slipped 150 basis points. So let's see what the reaction here is going to be. So, Nigel, I'm going to wonder whether IT can offer any sort of support to a market which has been really bleeding red for this week.
Well, I think so. There's going to be some support coming in from tech. And let me explain that in further detail. So the trend is weak. No two ways about it. On a day-to-day basis, any kind of bounce is getting sold into. And we have been seeing for the last few trading sessions, we're ending closer to the low point of the day. So the trend is weak. A short covering bounce is due. But how long before we get that? Could that be today? Could that be in the next week? We are due for a massive percent and a half move, at least in the next week or so. But we don't know whether it's today, but it's due, very much due. Now, just talking about tech, since that's going to be the top talking point, TCS's numbers, well, they were pretty okay. No, not running away to, for the bulls or for the bears. But the good point is yesterday, the index itself ended at the low point of the day. So whatever weakness you had to see, particularly in stocks like TCS, it's gone into its numbers week. And sometimes you don't mind that too much because they're talking about spends coming back, at least initial signs. And valuation-wise as well, TCS is cheaper than what it's been traditionally. So that's the good news. When the stock goes in weak, actually there is a case for it to recover from the low point of the day. So I'm expecting a recovery in tech in today's trading session. Moving to the FIs, what did they do in yesterday's trading session? Well, it's quite interesting because the FIs, both on the stock futures as well as on index futures, they've added short positions. That's on index futures, they added short positions, they unwound some longs. Even on stock futures, they added short positions and they unwound some longs. Doesn't take away from the fact that on stock futures, actually they're net long. While on the index itself, the FIs are net short out there. So we should pull that up for you on the screen. And the short positioning now is at its highest level we have seen in multiple months. And around these levels, you should be expecting some kind of a short covering bounce. But for that, you'll require some positive data points, which is not really coming about. So that's going to be important. On the stock futures, net long, though they've skimmed off a little bit. What about clients? Well, they are aggressively net long. Yesterday as well, they added long positions on index futures and overall on stock futures as well, they are net long. So they are clearly backing up this market. Moving to the options data then. Yesterday, had two stocks that were fairly active. 23,600 call, 23,500 put. And just take a look at the premiums. Plugging in those numbers, forget about the upside. For the time being, you want to know what about the downside. So the recent low becomes a first, point of support. That's around 23,460, which is the recent low. That band of around 23,450 to around 23,500, that's going to be important. Otherwise, you're referring to the low that we saw in November. And otherwise, if this breaks, then you're directly looking to the lows that we saw on election day. So these are the important marks that you're looking at. The problem is the Nifty Bank, it's broken all supports and it's trading decisively below the 200 EMA. So in case it needs to bounce, you'll want it to get back up towards the 200 EMA, which for the time being is close to around 1,000 points away. Stocks in focus, since tech is going to be top of mind, Tata Elxsi came out with the weakest set of numbers. I'll keep an eye on KPIT Technologies because normally, you see some kind of reaction. If there's a recovery, then maybe there could be a recovery on this one as well. But a read-through for KPIT Technologies is one of the stocks that I'll be tracking.
All right, Nigel, thanks very much for that. Let's talk flows, right? Cameron Brandt is now joining us. He's Director of Research at EPFR Global. Cameron, great to have you with us here on the program. Thank you very much for your time. Foreigners have continued to sell with some gusto, and sometimes with gusto, sometimes maybe, not with too much gusto, but it's been negative. Since September last year, FIs in India have sold another $20-25 billion, Cameron. What's the trend looking like? What can you tell us? And any indications out there when this will turn?
It's certainly from a mutual fund perspective, it has actually accelerated early in the new year. This week's redemptions from dedicated India equity funds are the biggest since the first quarter of 2022 on a weekly basis. And investor intention at the moment, it really is elsewhere. Most obvious candidate, of course, being the U.S. U.S. mandated bond, money market, and equity funds took in over $500 billion in the final 2 months of last year, and they've come out of the gate swinging again this year. And there's also sort of a contrarian bargain hunting spirit evident in the flows at the moment. If you truly believed everything that Trump had said recently, you wouldn't be increasing your exposure to ESG funds, Mexico, Canada. But in fact, all of those fund groups have seen fair to good inflows this week. And when it comes to emerging markets, the focus, at least for now, is back on China. Investors are sort of looking for cheaper markets and are testing the premise that these step-by-step stimulus measures that Chinese policymakers are unveiling will at some point catch on and help fuel something of a rebound in that market. I would say it's less sort of active hostility towards what India has to offer, though I think there's definitely a narrative that Indian equities have gotten expensive and a certain degree of correction is welcome. But it's more to do with the sort of investing universe focus being on the two heavyweights at the moment, the US and China.
That's interesting. Cameron, hi. Thanks for joining in. Interesting that you are picking up a flow back into China. I guess all eyes there on their next policy steps as well. But on emerging markets otherwise, I mean, overall, are EM funds getting any money or are there outflows? And I missed the point on India, on the India dedicated funds. Can you share some broad numbers? I mean, what's the inflow or outflow? What's the trend that you've noticed in the last few weeks?
So the trend has been accelerating outflows. Not to shocking levels, but as I said, this week's redemptions are the biggest, certainly in over 2 years, actually getting on for 3 years. And overall sentiment towards emerging markets ex-China is not particularly strong. The global emerging market funds, which is sort of a bellwether for broad sentiment towards the asset class, have not been doing particularly well. The one sort of bright spot in the emerging markets universe at the moment is the rather beaten up EMEA markets, where I think investors are doing a little positioning based on the fact that there's going to be some degree of peace breaking out in key markets. South Africa's worst case political scenarios have not materialized, and if anything, the best case scenario seems to be unfolding. And there's certainly hopes that fighting in the Ukraine and in much of the Middle East will dial down and maybe even cease in the first 6 months of next year. So in as much as there is any enthusiasm for emerging markets outside of China at the moment, it is actually focused in the EMEA universe.
All right, Cameron, absolutely got that. Thank you very much for joining us, and thank you for sharing those insights, those views. Appreciate it very much here on CNBC TV18 this Friday morning. Well, we'll take a quick commercial break, but before we go into that break, let me quickly run you through what's lined up here on the program. TCS, of course, is the big one. You'll hear from the management of the commentary, and you'll have the MD, CEO, CFO, CHRO join us at 8:45. You'll hear from Manik Taneja of Access Capital. We talk about, of course, what to do with the stock, TCS, not just TCS, but others as well. Andrew Holland at 9:20 will be talking markets. 9:30, we've got an interesting discussion lined up with Abhinandan Lodha, Chairman of the House of Abhinandan Lodha, and Santosh Kumar, Vice Chairman of Anurag Group. Last few days, we've heard some sound bites from companies talking about a little bit of slowdown in real estate sales. So we'll talk more. And then we'll have the management of Keynes Technology talk to us about EMS sector, how it's shaping up in 2025. Towards the end of the show, Ratha will be in conversation with a host of experts on when the MFI default cycle will peak. So that's the program as it is lined up.
All right, time to slip into a short break. We've got a lot of stock-specific action to track for you on the other side in our special Top 10 segment. For the time being, I give you a preview with regard to the list. TCS, NHPC, PTC India, MGL, and Adani Total Gas, all of them will be reacting to positive news flow. While Tata Elxsi, Adani Wilmar, L&T, IRDA, and SRF will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. As we've been telling you, a lot of markets across Asia are still flashing red, barring a little bit of green in Hong Kong. Even Taiwan's turned negative now. So the Hang Seng is the only market that's holding out positive. Largely speaking, expecting a very cautious start. Let's pull up the GIFT Nifty and the implied open. It'll come for you on the screen. It has been several down days, and today the start again is likely to be down, perhaps breaking even that level of 23,500. Let's see how it goes after that. We've got, of course, our team standing by with the CNBC-TV18 list of stocks to watch. Lots on the radar. But first up, of course, we kick it off with TCS. Rima, so the numbers were slightly weaker than the poll you did? At least on the revenue, that is.
Yes, on the revenue, it's slightly subdued and lower than what we were anticipating, but margins were in line, the deal wins were strong, and the commentary was upbeat. So first on the top line, dollar revenues for the company declined on a quarter-on-quarter basis by 1.7%. They were flat on account, they were flat in constant currency terms on account of seasonality. There were client-specific issues which the company has been facing in Q2, and it extended into Q3 as well. And that's the reason why the revenues ex of India, which is largely the BSNL contract, declined. EBIT margins, though, on expected lines expanded by 40 basis points to 24.5%. But that said, there were some positives. One, deal wins, which were in a band of $8 to $9 billion, increased to $10.2 billion, up 26%. So that's positive number one. Secondly, the management commentary is also upbeat. They're talking about early signs of discretionary spending revival, not just in BFSI, but even in retail, and maybe becoming more broad-based as the year goes by, which is why they're a little more upbeat on CY25 versus CY24. CLSA today has upgraded the stock to an outperform. They say the valuation is now attractive, and they also anticipate the company's EPS growth to pick up. So over FY 17 to 25, TCS's EPS growth was approximately about 9.5%. Now they expect that to inch up to 14%. So most brokerages acknowledge that revenues were a bit of a miss, but I think the deal wins and the management commentary will provide some sort of a support to the stock.
Well, support and maybe a little bit more. We'll see. Let's talk about IREDA. Now, Abhishek is standing by with why that is in focus. Abhishek, morning.
Morning, Prashant. So Q3 results of IREDA has come out and it surprised negatively on asset quality, with gross NPA in absolute value increasing more than 30% on a sequential basis and net NPA in absolute value increasing almost 54% on a sequential basis. So gross NPA ratio has increased to 2.7 versus 2.2%. Net NPA ratio has increased to 1.5% versus 1% in the previous quarter. Our disbursements were strong, 5% on a YY basis and 67% sequentially. The tenure of the loans have increased. My disbursements to AUM ratio calculation shows that it's close to 59-60% level. So the AUM growth is very healthy at about 36.3% YOY and 6.8% sequentially. Spreads have jumped to 2.28% versus 2.12% in the previous quarter and about 2.05% in the same quarter last year. Net interest margin largely stable, 3.33% versus 3.34% in the previous quarter. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's go back to Rima. She's here to tell us about Tata Elxsi. Rima, rather weak showing out there.
Yes, a little disappointing. So the company's revenues were flat on a quarter-on-quarter basis. On a year-on-year basis, the revenue growth has decelerated to 2%, which is lower than the trajectory. The reason for the miss is transportation, which is about 40-45% of their revenues, was growing very fast, and that slowed down. So transportation revenue growth was just 0.5%, and the problem is weakness in the automotive industry in Europe. So the other two verticals are, bounced back a little bit, but not enough. So media and communication growth was about 0.4%. Healthcare and life sciences growth was 1.1%. On a quarter-on-quarter basis, we also saw the company's margins decline to 26.3% at the EBITDA level, and that drove a 13% decline in the company's profitability. Morgan Stanley says Q3 misses expectation, weakness in European transportation continues, and significant recovery in media and healthcare remains elusive. They've lowered their revenue forecast to 5% for FY25 to 9 and 9.1% in FY26. That, coupled with high valuations, could result in the stock continuing to underperform. So, it's a little bit of a weak showing for Tata Elxsi in Q3.
Okay, all right, got it. Rima, thanks very much. So we'll watch out for both of those tech stocks, TCS and, of course, Tata Elxsi as well. Adani Wilmar is on the radar. There could be a OFS today. Abhishek is back with us with the details. Abhishek.
Well, sources do tell CNBC-TV18 that, there is a launch of OFS for Adani Wilmar. The promoter entity, that is Adani Commodities LLP, will sell stake. So, floor price is set at 275 rupees per share, which is a discount of 15% to the current market price. So, the base issue size is about 4,825 crore, representing 13.5% of the outstanding equity. Oversubscription is about 2,323 crores, which represents about 6.5% of the outstanding equity. So the total offer size is about 7,148 crore, which represents about 20% of the total outstanding equity. The BRLM to the issue are SBI Cap, Jefferies, Antique, ICICI Sec and Nuvama Wealth. So expect the stock to be in red due to the high discount that you are seeing of 15%. Back to you.
All right, Abhishek, thank you very much for that. Well, L&T is the next one we want to focus on. Vivek is here with more. Vivek, morning.
Well, good morning. L&T is in the eye of a social media storm. This is on the back of the chairman, S.N. Subramanian's comments. Now, there's actually a video that's gone viral on various social media platforms indicating that he has made some comments, number one, regarding on work hours, calling for almost 90-hour week work hours, and along with that, also working on Sundays. On the back of that, there's been significant backlash that the company has faced on social media. So we reached out to the management of L&T. They gave us a comment largely stating that, nation building is at the core of L&T's mandate. And basically, they've gone ahead and backed the chairman's statement. While there is obviously no financial and material, implication as far as these statements are concerned, significant sentiments are being seen as far as L&T is concerned. So it will remain in focus. Yesterday, the stock did underperform. So it'll be interesting to see whether there's any stock reaction on the back of this particular development.
Very, very interesting. Rarely is it that a social media sort of controversy or social media issue makes it to our top 10 tally, but then it was that kind of a comment. Let's see. In terms of brand, it's been an untarnished, absolutely phenomenal brand out of India. It's first time it seems to be in the eye of a bit of a public storm. We'll see how it plays out. But Vivek, back to more news. PTC and NHPC. Why are you watching for these stocks?
Well, interesting development both on PTC as well as NHPC. Mint article reports that NHPC is eyeing acquisition of PTC India. This particular acquisition is mainly aimed at acquiring the power trading arm. So PTC India Financial Services, which is a listed entity and a subsidiary of PTC India, is not expected to be a part of this deal in case this particular deal fructifies. So reports indicate that the promoters are eyeing an exit, and talks are likely to intensify at a meeting scheduled on January 12th, and with the presence of the Union Power Ministry as well in this particular meeting. So looking at the current shareholding of PTC India, who are the promoters? NHPC, NTPC, Power Grid and Power Finance Corp. All of them hold a little over 4% stake, totaling to a little over 16% stake held by the promoters. It'll be an interesting development given the fact that NHPC already has significant presence in this particular area. And if NHPC does manage to get or this particular deal fructifies, it will be a significant acquisition as far as their own portfolio is concerned. Watch out for both of these stocks. We've reached out to the management of both NHPC as well as PTC India. We are awaiting a response from both of the managements.
Okay, that's a pretty interesting story and could be a huge deal in the power space, in the PSU space as well, if it plays out. Thank you for that. But quickly moving on, Mangalam's here. He's watching out for MGL and I think Adani Total Gas. Mangalam, what's the news?
That's right. So, yesterday during the markets, we got an update coming in from IGL saying that the domestic gas at APM prices for them have been increased. The allocation for them have been increased. And the street was hoping that this would come by for all the other players as well. And that's exactly what happened. So MGL as well as Adani Total Gas informed the exchanges post-market that for MGL, domestic gas at APM price, which is at a lower price, has been increased from 37% to 51% with effect from Jan 16. And Adani Total Gas as well has said that APM gas has been revised upwards for them in terms of allocation by 20%. Both these companies will stand to benefit from that, just as IGL had said that revision will have a positive impact on the profitability of this company. Remember, when these allocations were cut back in the day, there was a fair amount of derating for all these stocks. But now that this has been increased, the street may see some relief coming in for these gas stocks.
All right, Mangalam, thanks a lot for that. Well, I'm keeping an eye out on SRF. Yesterday, SRF and Navin Fluorine were the two big gainers. Now, post-market hours, we had SRF that's come out with the clarification on the exchanges. And the reason the stocks went up was because, iGas, which is the US refrigerant gas distributor, had said that prices could move up by around 100-200% as well. but they've mentioned in their clarification that it's not necessary that the prices go up by as much. The reference that is being made is that to this statement that came in from iGas, they say that demand and supply is the ultimate reason that the prices will go up. And this geography that they have some kind of exposure depends on the demand-supply scenario out there. Various notes have come out post-market hours as well, and some believe that yesterday's move was an exaggerated one on the upside. So expecting the stock to be a little bit soft because of this clarification that's come about, and because in fact some of these sales notes have indicated that the price increase hasn't been as much as this 100-200%. It's been in the vicinity of around 5 to around 20% at least as of now.
Okay, all right. So that's the latest on SRF. Let's quickly recap the list of stocks that we need to watch today. The ones that have positive news flow around them are TCS, NHPC, BTC India, MGL and Adani Total Gas. Plenty of names with negative news flow around them as well. Tata Elxsi, Adani, Wilmar, L&T, Irida and SRF. Okay, let's now look at the commodity cues that we're getting in this Friday morning as well. Manisha is joining in. Manisha, good morning to you. So what's the latest? I mean, the rise in Brent oil prices caught our attention as well. 77 now.
Oh, well, yes. We've been looking at higher highs when it comes to the crude oil prices. After 3% of decline in the previous week, the crude oil prices have gained up by 4.5% in this year until now, and it's just 10th of January right now. So, well, yes, very bullish cues coming in. There is fund allocations that we've seen happen in the crude oil prices also. And then the fundamentals have been stronger because the U.S. crude inventories have continued to decline. The cold weather demand has been higher. The Russian crude exports and the OPEC production also have seen a decline in the month of December. So all of that is finding its way into prices. It is a metal sector that you need to watch out for because while the precious metals have done well, the strength in US dollar index also has not deterred the kind of gains that we've seen in the base metal prices also. So overnight, whether it has been about copper, aluminum, zinc, we've seen gains coming in across. The best of the gains for this year until now have been in copper. The prices are trading at a 3-month highs, and we've seen almost an 8% of gain come in for copper prices till time.
Okay, all right, Manisha, got that. Thanks very much for the cues. On that note, we'll take a very quick break. Come back on the other side. We'll have Siddharth Khemka, Head Retail Research at Motilal Oswal, joining in. We'll discuss some fundamental ideas and also some of those earnings reactions with him.
Welcome back. Hope you're having a good Friday morning. It's been challenging times for the markets of late, but over the longer duration, the market should see good compounded returns. So we'll have to see how the near term goes, but the longer term, the market should look quite good. Let's get in a call on a couple of stocks. We have Sid Khemka, Head Retail Research at Motilal Oswal, who joins us on the show. Hi, Sid. Good morning. Good to see you win. Let's talk about the tech numbers first. TCS as well as Tata Elxsi. Yesterday, had the tech index itself that ended at the low point of the day. Your view on the numbers, and also what's the read-through for the tech pack? What do you like best?
Good morning, Nigel. Glad to be on the show. So if you look at TCS, broadly in-line numbers, you'd say revenue a bit miss. But what was the good part was, or what was encouraging was the management commentary about the improvement in the demand scenario. It clearly indicates that discretionary spending is up on the rise, and we are seeing that through spreading not only to the BFSI sector, but also other verticals such as high-tech and retail, where the tech spend recovery is expected in the next few quarters. So I think that's a very positive read-through for the large IT companies, especially for the IT services companies. And the other part was the deal wins and the TCVs, so the contract values, that continues to remain strong. One peculiar point that we saw is that there was more of small deals rather than large mega deal wins, which again shows that the granularity in the order book, which is more sustainable going forward. So net, I think a good read-through for other IT companies, large IT services companies, for example, HCL Tech, Infosys, LTIM. We believe that should be positive going forward. The other company, Tata Elxsi, I think the ERD spends, that is after a very significant good growth, is seeing a decline and is not a positive read-through, not only for Tata Elxsi, but the others in the similar space. For example, you have KPIT, you have the LTTS. So these three, I think, could be under pressure on back of the weak Tata Elxsi numbers, but a positive read-through for Infosys, HCL Tech, LTIM from TCS numbers.
Okay, got that. Hi, Siddharth. Good to have you on the show and happy Friday to you. Do you have any interest in these city gas distribution stocks? And they dance around to news, quite rapidly. We had the massive derating earlier on, a couple of weeks back, and now that they're getting a little more gas than what was, earlier projected, we saw a relief rally in the likes of IGL play out yesterday as well. What would your thoughts be? Would you look at anything here?
Yeah, good morning. Thank you, and happy Friday to you too as well. If you look at the gas space, there has been changes in regulations and the recent news flows about the lower gas allocation from the domestic, the APM gas. That was a bit negative. But yesterday, IGL in its press release has stated that the domestic gas allocation has been increased by 31% with effect from January. I think that's a very big positive. What we had seen earlier is that with the company getting lesser allocation from APM, they would have to buy gas from outside, and that would lead to higher cost. And hence we saw some of the companies, especially IGL, taking a price hike in the northern region, barring Delhi. But Delhi is the key region for them. 60-70% of the business comes from there. But now with this news, I think that's positive. The other news that came in was MGL taking a price hike, which had not taken the price hike after IGL. So I think that's also a positive read-through. So within both the companies, we would be more tuned towards an MGL where, again, today they have taken a price hike in the Mumbai region. They're much more stable in terms of impact from the overall regulation. Plus, they have also been allocated more gas in the recent update. So I think among the two, IGL, MGL, we would prefer an MGL, given its stronghold in the Mumbai region, as well as the stable business environment here.
Okay, all right. I think, there's 20 minutes to go for the pre-open session. So we're slowly coming around with some of this. Siddharth, FMCG, the index, maybe it already sold off. It did sell off. Oil and gas and FMCG were two areas which saw a fair bit of selling. Yesterday, we saw some signs of life. Nestle, HUL, Britannia, Tata Consumer. These are all names just in the Nifty, not going outside the Nifty, which were the top gainers. Any thoughts here?
Yeah, hi Prashant, good morning. I think, yes, if you look at in the current volatile environment, while in terms of earnings, you would not expect a strong earnings in the base consumption or the staples business, given the weak demand and sluggish urban segment. What has been seen is that valuations are comfortable, and given the market overall environment and the sell-off, there does emerge value buying in some of these stocks where you would expect that during the course of the year, you would see some recovery, because that these are sectors where you would see demand coming back in 1 or 2 or more quarters with some of the raw material prices being stable. So what we like HUL among the largest players, most diversified business. ITC is looking very strong, and with now the demerger thing done with, the focus would be on the core business of cigarettes and FMCG. So I would say within the staples, what one could focus on, HUL, where we have a buy rating target price of 3,100, and ITC again looks attractive at the current valuation.
All right, got that. Siddharth, thanks for that. We do need to take a quick break on that note, come back on the other side, and we will have the management of TCS with us. They will detail not only the third quarter, but of course, their more optimistic sounding outlook for 2025.
The big story today, of course, is TCS, which reported numbers yesterday. Revenues are largely in line with expectations. Margins are up about 40 basis points, but the commentary for 2025 calendar and FY26 financial year sounding a lot more positive. I mean, this from the CEO himself. We spoke with him along with the CFO and the CHRO of the company. Rima and I sat down for that conversation. Listen in.
The BSNL order, as we called out, was running at its peak in Q2. It has remained at similar levels. It has not increased. The execution is going quite strong. 70% of the overall work in terms of installation and commissioning also has been completed. About 60,000 towers are running commercial traffic. As we had called out, we should expect it to, run over between Q4 and Q1 of FY26. Coming to from a margin perspective, we did have 40 basis point improvement in spite of furloughs and the Q3 seasonality, including, like you saw, the seasonality in India. In spite of that, we had operational efficiencies helping on the margin front, and primarily kick-started by productivity, utilization, and pyramid.
Kriti, was the impact of furloughs more than anticipated, and will furloughs extend into Q4?
Q3 furloughs more or less in line like last year, and there will be some extension, particularly in Australia, where furloughs tend to go up to the third week of January. But again, that's also overall furlough is similar to last year.
If furloughs were in line with expectations, your revenues ex of India, which maybe BSNL or other contract, has fallen quite significantly. Even BFSI is under pressure quarter on quarter. So what explains that?
See, furlough was on expectation, but we did have some one-off issues. Like, last quarter also we had called about a couple of accounts. They are bottoming out. So there were some client-specific one-off issues that bottoming out in Q3. So that also had some role in that. But if you look at overall, I would say that it's more or less on this is what we are expecting for this quarter.
Can you talk to us about the one-off client-specific issues? Were they the same as what we saw in Q2, healthcare, or any new one?
Yeah, we talked about healthcare issue. Okay, that was supposed to continue and bottom out in this quarter. That's what has happened.
No fresh ones, no fresh project cancellation or culls.
No fresh ones.
Just to go back to that BSNL bit, Samir, it's about what 5% of your annualized kind of.
We don't call out client-specific ones, but
right. No, my only question is once that runs out, you'll have that sort of hole to fill in that sense.
Absolutely.
What will be the impact in beyond 26 once it starts? So you said 70% of the work is done, 30% is left. So
right.
go on.
The existing contract runs out. We have opportunities. It's a first of a kind which has been done, and there isn't many players who can execute indigenous network in India, and that should open up further opportunities on a like-to-like basis. And yes, absolutely. It needs a replacement, and it need not be on that. We have had, in general, good order wins in Q3, and yes, it's part and parcel of the overall thing.
BSNL revenues have peaked in Q3. Does it drop off from Q4?
It is likely to drop off. When it's 70%. It is likely.
Okay. And can you explain the margin improvement? What led to it despite no growth?
As I said, the furloughs were the headwinds, and from a tailwinds perspective, it was purely operational efficiency led by productivity, better utilization, and also the right sizing on pyramid.
Okay, and so Q4 onwards, or in Q4 and beyond, can we expect margins to improve, Sameer? Given the rupee depreciation, given the BSNL contract is waning now, is there a margin tailwind in Q4 and FY26?
As we always call out, we would want to inch up and we'll want to get closer to 26 earlier than possible. And the ones which I talked about, the operational efficiency levers, do provide additional headwinds in the short term, and we will be banking on them here and beyond. I think I've always been calling out pricing. Product mix also is something which we could look at in a medium to long term.
So Q4 exit margins would be closer to 25?
As we don't call it out. We'll like to get to closer to 26.
26 to 28, I mean...
Is the guiding peak.
So that remains, right? There's no change.
Yes, 26 to 28 remains.
Right. In terms of deals, just to go back to that, what is driving it? Is it cost optimization? Is it what kind of work is leading up to this big number?
See, we have started seeing some amount of improvement in decision making around discretionary projects. Okay. So it's not purely cost optimization. One of the interesting areas we see is tech modernization is picking up, and in run up to leveraging AI, there is more work around data that's picking up. So data, cloud, tech modernization, three important levers, apart from cost optimization levers around operational model transformation.
And this is, of course, also when we should start talking about the new administration. And Milind, I'm coming to you. I think you'll have your hands full with at least some questions from us on H1B and whatnot. But just your sense, Mr. Krithivasan, has the momentum picked up in North America? Are you seeing visible signs? You said some improvement on the discretionary side.
I said one discretionary spend, we are seeing some improvement on discretionary spend. In fact, one interesting observation we had this quarter is deal cycle has shrunk by a few weeks, which is also important, which means that more decisions are being taken. So there are definitely good signs, positive signs for the future. As long as something unforeseen doesn't happen, we are quite positive.
And discretionary spending is picking up in which all verticals?
Definitely we see in banking and retail. And to some extent, see, one segment that we'll wait and watch would be life sciences and healthcare. Even telecom, as the interest rates go down, telecom also would start seeing some amount of discretionary spend.
So do you expect discretionary spending to be more broad-based Q4 onwards? Do you have that kind of visibility?
I would expect that.
Go beyond the FSI and
Absolutely, yeah.
This is positive. I mean, much more positive than when the last time we spoke. Would you agree? In terms of commentary and
we are actually from a CY 25 to 26 perspective, we are definitely more positive on CY 26 at this time.
Okay. On headcount, give us the highlights, and then we'll of course get into what can happen, what may happen, etc.
So you mean headcount in this quarter? Or?
This quarter.
Yeah, it has gone down. And like I say always, and I will repeat that there is no linear correlation between.
So 2 quarters it went up. And this quarter
and
gone down,
that is one of the reasons, right? We actually have been 11,000 plus net addition in the last 2 quarters. This year, because of this quarter, because of various aspects, and we make these calls not just for a quarter, but through the year in terms of how we want to add people every quarter. And that's how they ended up being for reasons of productivity, utilization, pyramid, like what Sameer talked about. Eventually ended up being at a negative headcount.
And you maintained in the past that headcount addition is not really in a linear way correlated to revenue opportunity.
Yes, right.
You maintain that.
That's right.
I mean, actually, you're sounding more confident, but you're not.
That's right.
I mean, headcount has gone down.
I can basically say that we actually are on track to hire 40,000 trainees this year. All of that is a very positive trend, and I'm actually planning to do more than 40,000 next year.
And what led to the jump in attrition to 13%?
No, it is minor changes here and there with respect to that. I'm not much worried about that. It is it is there is no specific place where I can point a finger at, but this is something which is within our comfort band. And
quarter-on-quarter basis, it is actually very insignificant.
But is attrition on a rising trend?
No. See, I think overall, I actually see a reduction in attrition in the coming quarters. LTM numbers may show otherwise because of the way it is calculated, but otherwise quarterly attritions may come down coming forward.
Milind, what is your perspective on this entire H1B? I mean, last 10 days of December really exploded, at least on social media. Incoming President Trump was asked, he said, well, he's very supportive of that program. They need skilled sort of immigrants to come in, very much needed. So that is there, but this is it's an issue which is likely to persist. Your thoughts?
There are many things we are dealing with. This is not the one which is the top of my mind right now, because of the reason that we have been, have a global operating model, global workforce. We have been hiring people across all locations.
What is your dependence on US visas? Is it very?
No, it is reduced over a period of time.
Our US visa dependence is not very significant. You get about 3,000?
It is reduced significantly.
We about 3,000, 3,500 visas per year. So it's not a very significant number. We actually changed our model. Like we are more than 50% local workforce in US. So our dependence is.
We have seen this before. It's not the first time it's happening.
But it's happening in a much more kind of...
a lot more news, yes, absolutely. But I think our model is very robust in terms of dealing with this.
What about tariffs? I mean, on services, for example, is it possible? And are you guys thinking about it? I mean, Krithivasan, if you want to take it?
It's a wait and watch. Too early to call out, and we'll be prepared for it. It would be an industry-wide thing.
It'll obviously, if it happens, it'll also affect, global GCCs here in India, which is servicing the US market, right?
Yes. Yeah. See, anyway, we cannot plan for it. We can look at multiple scenarios, but we have to readjust and recalibrate as and when something happens.
How's the pipeline, Kriti? After the strong deal wins that you've seen?
Pipeline's still quite good. But as I said, particularly North America is very good. It's actually increasing pipeline despite the strong deal wins. And across almost all industry verticals, we find the pipeline to be also strong.
So pretty much at similar levels to Q2, the pipeline, or has it expanded?
See, because there is a much higher TCV win, there is a marginal dip at the overall level, but at key market level we are good.
And the AI and Gen AI pipeline, which was at $1.5 billion, I think.
It's continuing to be very strong. Like we stopped publishing those numbers because it's becoming more and more commonplace. Like there are so many AI projects happening. So the focus now is to improve the level. Like previously we did a lot of smaller and simpler projects. More projects are going into production now. We are looking into more complex projects. So the numbers don't matter too much anymore.
Three sectors which you've spoken about in the past which are looking a little challenging: manufacturing, telecom, life sciences. I think life sciences, you said you're hopeful of maybe a turn?
Life sciences is subject to the US policy decisions around insurance and healthcare and all. So that's we are more on a wait and watch mode on what happens. Telecom, I am more positive because as the interest rates go down, that's a very capex heavy industry. So as the interest rate goes down, more discretionary spend should happen. So what is the third industry?
Manufacturing.
See, manufacturing, from whatever I'm hearing, from next fiscal year, things should look good. Okay. We don't make a Q4, like I don't want to comment on immediate quarter, but there also you see like traditional auto, their sales are picking up. So industry is in some sort of a flux, but we believe from our Q1 onwards, things should improve for manufacturing.
It's looking, for the US at least, the slogan is America first.
Yeah.
For IT services companies, that is still the biggest market. For you, it is a very, very important market as well. So, they're trying to juice up growth in the US, which should benefit. But on interest rates, for example, I've heard you say last 2 quarters, that's also an important macro variable, right? Now, one is not very sure whether those interest rate cuts will happen because growth is expected to be strong. But at the margin, it makes you more positive, all of this?
Overall, we are, as I said, quite positive.
Quite positive.
And UK and Europe?
See, from a market side, they are also expected, their GDP is expected to improve, not significantly, but GDP is expected to improve. And particularly in UK, what I'm hearing is government spending may go up, which can boost the overall spend in the economy. And Europe also consumer confidence is better. So overall, as I said, our current sentiment is more positive on CY25.
So do you think FY26 will be better than FY25?
It should be.
It should be. And client budgets have closed?
I won't say it's closed, but based on the initial conversation with our teams, at least the budgets have a positive upward bias.
Welcome back. So you just heard the TCS management striking an upbeat note on demand on a pickup in discretionary spends, shortening of deal cycles as well. Let's see how the stock reacts to it. Let's, with that, move to our technical experts as well. We've got Mitesh Thakkar as well as Shrikant Chauhan with us today. Gentlemen, good morning and happy Friday to both of you. Let's start with the market setup first. Mitesh, it's been a tough crunching week, right, at the index level. Any trades, Nifty or Bank Nifty today?
Good morning, Savi. See, I think, the index at least has given you a directional move now. Whether you are in the direction of declining mode or not, I think that is the key question. But broadly, the Bank Nifty, one has is on its way to record a weekly close below 50,500, which is negative, and a daily close below 49,750. I think all this suggests that even if there is a pullback today, and these levels are not being captured, then I think we are in for next 2-3 weeks of more volatility with downward bias. So I think we are looking at much lower levels in the coming few weeks as we run up to the budget, maybe, till last week of January. Having said that, I think today the idea should be on the Nifty to see if 23,500 after, because we are seeing the GIFT Nifty indicate a gap down of about 60 odd points. So keep a watch on 23,500 spot levels. We will open below that. And if we capture it back, I think then today there could be a pullback, possibly to about 23,750, 800 zones. Otherwise, I think, the market might end lower in the day. So post the opening, my immediate view for the next half an hour is to see if we can climb about 23,500.
Okay, all right. Gentlemen, morning. Shrikant is with us today, Friday mornings as always. Shrikant, what about you? How are you feeling?
Good morning, Prashant, and good morning, everyone. We believe that the markets are going to remain in a range. No doubt that at every rise we are seeing good amount of selling pressure in the market. But if we see the overall trend of the market, then the fall is quite gradual since the last 2 days. And the next level to watch out for would be 23,400 levels. So between this 23,500 and 400, the market is having good amount of support. And today I'm expecting market to find support somewhere close to those levels. And again, we could see some rebound in the market because the flows are completely muted. At the same time, on the higher side, 23,700 is going to act as resistance. So today, in case if we see furthermore weakness in the first half, then in the second half, I'm expecting rebound in the market. For the Bank Nifty, there also I'm seeing, yes, there is a weakness, but at the same time, the Bank Nifty is completely oversold along with its components. So close to 49,000, 48,700 levels, the Bank Nifty is having excellent support. And from there, we need to see that whether it is forming any reversal formation or not. But broadly, I'm of the view that till the markets are not breaking 23,400, we could see range bound sort of activity in this market.
Okay, all right, let's get to stock-specific action. Then, Mitesh, you go first. What's on your radar?
Morning, Nigel. I have a mix of buys and sells. Bajaj Finance is a buy with a stop below 72.29 for targets of around 7,400. Coforge is a sell if it breaks 92.50. Keep a stop at 93.50. Look for targets of 9,050 with a disclaimer that we have some put options positions over there. iShare Motors, after a big breakout and has seen some kind of pullback in the last few days, so now offers a good entry point. Keep a stop below 50.80 here. Look for targets of 52.50. And Ashok Leyland has broken down, so that's a sell call. Sell here with a stop at 218.5 for targets of 206.
Mitesh, what about Srikanth? What about you? What are your picks?
Yeah, I think again we need to keep a mixed sort of strategy in this market, and based on the overall structure of the stocks, we should look for creating some short positions on Coal India. The reason is because it has broken its important support level at 380, 375, and below that the stock can fall to the next levels of maybe 340, 335. So from here, Coal India looks weak, and we should look for creating short positions with a stop loss close to 385. The other stock on which we are bullish is Mahanagar Gas. The reason is that it has taken a lot of time and it is consolidating since last almost 7-8 days. So from here, the stock can again move back to the levels of 1320, 1330 in the near term. That's the view. And in case if there is any correction, then I think it should not fall below the levels of 1250. So 1250 should be the final stop loss for adding long positions on MGL.
Correct, gentlemen. We'll come back to you all for your 9-10 call, but thanks a lot for that. Well, let's focus on the big earnings that came in yesterday. TCS, Tata Elxsi, both of them reported numbers. We have Manik Taneja, the Executive Director, IT Service and Internet at Axis Capital, who joins us on the show. Hi, Manik. Good morning. Hope you're feeling good. It must have been a busy evening yesterday. But tell us about how do you read the numbers, the TCS numbers first. The stock went into the numbers at the low point of the day, which actually could be a blessing. The commentary seemed a little bit positive, and it seems the street could latch on to that. Your view on the stock?
Good morning, Nigel. Thank you for having me on the show. So certainly the stock's been weak in the run-up to results, and thereby that could drive some up moves in general. That being said, we reckon that TCS's relative growth underperformance for compared to tier 1 peers is likely to stay into calendar year 25/FY26, notwithstanding the positive commentary, given the fact that the absence of BSNL revenues next year will be a big drag at company-wide growth, and because of which TCS will fare relatively poor compared to the likes of Infosys and HCL Tech on revenue growth in FY26.
Okay, all right. And what's the current rating you have on TCS?
So we have a reduced rating on TCS. Our preferred tier 1 peers or tier 1 picks are Wipro and Infosys. That's how we position.
Okay, all right. Wipro and Infosys you prefer in comparison to TCS. Got that. What about the mid-cap space? Tata Elxsi's numbers are weak. The stock has seen a sharp correction from the top, as has been the case with the KPIT Technologies as well. Your comment on this one?
So Tata, almost all the auto ER&D companies are likely to essentially see a soft performance for the foreseeable future. I would say the rate of change in general for auto ER&D companies should be negative over the foreseeable future compared to the fact that rate of change will be positive for IT services companies. And in that backdrop, the ER&D valuation premium should continue to come off. And even for Tata Elxsi in particular, for the last couple of years, their growth had been supported only by the automotive vertical. They had been struggling in the other two industry segments. Even if one were to bake in a growth improvement from these industries in FY26, the slower growth on the automotive side will mean that Tata Elxsi will likely post another year of possibly a mid-single digit growth at best. And all these things will essentially mean that multiples will continue to come off for Tata Elxsi.
Manik, hi, good morning. Is there a tactical kind of a trade here in IT services, and which would the stocks be really? Which one should look at?
So I would reckon that the likes of Infosys and even Wipro, relative to where the expectations are, should fare better with the upcoming earnings, and that's where I would rather play those stocks over the likes of TCS and even possibly HCL Tech amongst the tier 1 peers. Amongst the tier 2 names, the names that we like are Zensar, Sagility and FirstSource.
Okay, Zensar, Sagility and FirstSource. Is it possible at all that maybe, with all this focus, Manik, on the US in a big way, it becomes a slightly macro-ish kind of a trade? Or you think the sector is just too large for that to play out? and people will just wait for actual numbers to show up. Your sense?
So certainly that macro trade is valid, and I would say the rate of change in the sector essentially, certainly with the way things are placed, look better into CY25/FY26. The challenge that we face when it comes to India listed names is that most names trade at par or at premium to last 3 or 5 year averages. Global tech services offer better risk reward given the relative price underperformance or compared to Indian IT, and the fact that those companies trade at lower multiples compared to their own historical levels. So if I were an investor who could buy tech services in India, could buy tech services in the US, I would rather play the likes of Accenture, Cognizant, or Capgemini of the world, or even the EPAM and Davos Globals of the world on a relative basis.
Okay, got it. Manik, we'll leave it there. Thank you very much for joining us and running us through what you would do in the IT services space and what you wouldn't do. So we'll see, as Manik said, maybe off of the TCS commentary and results, etc. Maybe Infi and I think he said HCL Tech perhaps better placed as tactical trades. TCS will come up on your screen. The IT index is up. TCS is up 4%. So it's a big pop, 4,200 rupees. And look at Infosys and HCL Tech. Maybe just a sampling of the other 3-4 large names. Infi starting about 1% higher. HCL Tech is absolutely flat. Tech Mahindra maybe also we should put out. Persistent, Coforge also I think we should take a look at in the pre-open session if something is moving. In terms of just earnings growth expectations, I mean, those are the two which have got the highest, Coforge and Persistent. So we'll see how things go. But for now, I think it's a higher start for the index at the end of the pre-open session. The Nifty is also going to come up on your screen, and we're about 25 odd points higher. Nigel, you wanted to come in?
Well, I was just talking about the TCS reaction. That could be a factor, the technical factor at play, right? The stock ends at the low point of the day. Yeah. There were the shots that got bought into the system. So that's why, irrespective of the numbers, this initial pop is because of that. And Tata Elxsi on the flip side, that one's got smacked. It's pulled back close to 8% in pre-open. I'll be wondering of whether or not there is a temptation that the stock sees some kind of buying from lower levels. Numbers are weak, but we'll have to see whether or not the street wants to extend the long handle to them. Let's focus on a couple of other names though. MGL and IGL. Mangalam had told us earlier today about the news. MK has gone ahead and upgraded the stocks. Mangalam, tell us more.
There has been a brokerage upgrade coming in on the back of the developments that came by yesterday itself. MK has gone ahead and upgraded IGL from reduced to add with a 17% upward revision in their target price at around 450 rupees. MGL as well has been upgraded to buy from add with a 21% uptick in their price as well. Why is that? Because remember, the government has reversed a significant portion of the APM gas allocation cut for CNG to 51% of the CNG volumes with effect from Jan 16th itself from 37% currently. For them, IGL and MGL to go ahead and make the pre-reversal or pre-allocation cut margins, they have to increase their prices by about 4 to 5 rupees for IGL and 2 to 3 rupees for MGL itself. And on the back of that, the fourth quarter is likely to be good for both IGL and MGL because of this partial reversal of APM allocation cut and possible price hikes that these companies would take as well. And as a result of which, there would be an upward revision that they can expect on their EBITDA estimates. So the development that took place yesterday tilts in favor of these gas stocks.
Okay, all right, Mangalam, got it. So we'll keep the gas players on our radar as well. But for the time being, what the pre-open is suggesting is that it's going to be IT up and banks, not sure down or not, but there's a little bit of a tinge of red on some of the larger banking names. IndusInd Bank, for instance, is down. By the way, L&T could be starting about 1% lower as well. TCS, I think, is very clear. This is what we were discussing even earlier, right? The fact that it's going to be a very flat quarter in terms of revenue, that was in the price because the stock corrected 10% in December when the market corrected only 5%. And now on top of it, you have, broader commentary on a pickup in discretionary spends, on a pickup in, more verticals, Prashant. I guess they're saying beyond banking, there's telecom, there's retail, there are other engines that seem to be firing. And they're saying it's looking good. And this is a management, and you would know this better, right? You've been speaking to them for I don't know how many quarters. This is the management that is probably very shy of giving any clear directional color. But this time they've done that. So I see it as it's pretty major.
Yeah, no, absolutely. And they're sounding positive, absolutely, compared to the last 2-3 quarters. No taking away from it. And I actually asked them, I sort of wanted to confirm whether they themselves think what they're saying is more, more positive, because there's no numerical guidance, and they kind of agreed. So in that sense, it is positive. How much will it do for the stock after the initial pop is the question, or will, gains start to fizzle out a little bit after a 4% start higher? We'll have to watch out for. What do we have? First kind of rates which will come up on your screens. We'll look at the indices, and then we'll look at individual names as we always do. The 25-point pop is 40 at start on the Nifty. So yeah, 40 points, 23,560. The sensex is up about 120 points. The Nifty Bank, which of course is looking much weaker, is starting about 0.14% lower. Mid-cap index is up 0.17. Small cap index also starting up right now. So yeah, the IT stocks, the stack is at the bottom of the screen, and they're all higher and opening in line with what the pre-open was indicating. The Nifty heat map on your screen, it's largely down, and about 15 odd stocks are higher. 35 stocks approximately are in the red this morning. So 23,570 or so is where we are starting. Surabhi.
Okay, let's talk about the movers and shakers, and it's all about IT, and TCS has sparked hopes across the sector, really. When the large titan is talking about a pickup in discretionary spends in many of the big verticals, the others have a similar fate. 4% up on TCS, Tech Mahindra 3.5% higher, Infosys 2% higher, Wipro, HCL Tech. It's literally IT to the rescue all the way. The problem, however, is that now banks are not playing ball. The bank Nifty is down about 0.25% right now. Let's look at what the biggies are doing. IndusInd Bank is the one that's seeing the maximum pressure, down about 1%. SBI is also on the lower side. HDFC Bank is very flat. Let's see. If HDFC Bank decides to go green, then things can really turn. ICICI Bank is down 0.25% as well. So that's the two large pillars of the market. Other than that, positivity would include BPCL, Dr. Reddy's, Apollo Hospitals, and Sun Pharma. So it's a bit of an IT and pharma morning, at least as of now. Reliance is sitting at the flat line. Let's see, will it go back to its winning ways? We just had that one green day on Reliance this week, and then it fizzled out. Let's see what happens. But on the downside, apart from some of the banking names, weakness comes in the form of Hindalco, Tata Consumer, BEL. By the way, Britannia Lever, yesterday's FMCG sort of rally has completely fizzled out this morning. It's not sustaining. ITC is also slightly lower. So these are the early indications. FMCG is down. Banking is negative. It's IT that is seeing the bulk of the buying, 34 points up on the Nifty.
Well, just one quick word on, Tata Elxsi. That was the one that opened up with a cut, I think, of around 7.5% that we spotted in, in pre-open. But that's recovered considerably, actually, from the day's low. So it's up 2.5%. We'll see whether or not it's a trading pop, or in fact, that one as well could see a bit of a recovery. KPIT Technologies, because of this weak set of numbers, the street sometimes extrapolates that. So that's why that stock is under some pressure. A couple of other notable losers from the broader markets. You have Apollo Microsystems, one of those big moves that we saw in the past week. That stock has given up almost all of those gains. So that one comes up for you on the screen. Now, First Source, one of the stocks that, Manik just spoke about, of Axis Capital. He said he likes that name. That one's opened up well in the green. And we have that story that's come in from Sapna that we'll get her in just a bit. She's talking about the Petroleum Ministry is seeking 35,000 crores for LPG under recoveries of OMCs, and the cash compensation sought from the Finance Ministry can be in tranches as well. So some of these OMCs have popped up in trades, Surabhi.
Okay, I'm looking at ONGC. Let's just go back to the ONGC rate. It's down a little bit. Yesterday was down almost 3% or so. And Oil India was also decidedly lower yesterday. Let's pull up the Oil India rate this morning. We'll get to the Sapna story in just a bit. There is chatter that there is some subsidy coming in for the oil refining and marketing companies. Now, the question is whether we go back to the old ways of ONGC footing the bill. That is the bit of a concern at this point in time. So we'll get Sapna in on it in just a bit. Oil India is flat as of now, not doing too much. So those are some of the early indications that we have. What else? In the mid-cap arena, the color is red. There's no taking away from that. RVNL, Aerocon, Union Bank, NBCC, GAIL, BEL. It's been a really bad week for PSU stocks, by the way. The PSU index itself is down about 4.5%. With this cut, it could be almost 5% now. But PSUs have been absolutely out of favor, and that trend is continuing this morning as well. I think we'll get to Andrew in just a bit. Andrew Holland is our market master this morning. Actually, I think we do have him now. So let's straight away get to the conversation then. Andrew, hi, good morning. Season's greetings to you. Wish you a very happy 2025. Now, it's not been a very happy start to 2025 for Indian equity investors, right? They're keeping the faith. They're, continuing with their SIPs and their mutual fund inflows. But this foreign selling has been really difficult, and it's showing no signs of stabilizing. What do you make of it?
Well, I think we spoke about this before the new year, actually, in terms of I think foreign portfolio investors are going to wait now to see what President-elect Trump does. In that respect, you've seen the dollar rising, bond yields rising in the US. So therefore, there's no real need to kind of jump into emerging markets until you can see clearly what these policies might be. I think you're kind of in that kind of, is it going to be more shock and awe in terms of what Trump does, or is it going to be more tempered in terms of the the kind of the policies and tariffs that is being rumored to be implemented? So I think a lot of people are just sitting on the sidelines saying, if there's any market rally or there's any kind of risk which is being played through the currency markets, then if you feel that that the earnings season is not going to be so good, the budget might not come to the rescue, then valuations remain quite high. So I would have thought that's just an easy risk off the table kind of trade, which foreign investors are making at the moment.
Oh, okay, all right. So that remains a risk, Andrew. We take that point. But then the other issue is this debate about a slowdown here in India and earnings, right? What do you make of this? And actually, let's start with IT, because that's the silver lining that we've got. TCS sounding pretty optimistic in the last 12 hours when our colleagues did the interview. Can IT be a bit of a pillar for this market?
Yeah, I mean, it can be, listen, when markets fall, the safe havens are usually FMCG, IT and pharma, and that's probably what we've been seeing more recently as well. So, the TCS results, were below expectations, I think, for most analysts, but, the commentary was strong, as you mentioned, or positive. But that doesn't mean that, the whole IT sector is out of the woods, but obviously they have tailwinds in terms of the currency at the moment. So that will probably keep the positive kind of views on the sector. As regards the economy, we've been the RBI is still too high in its forecast. I think GDP is probably trending more towards 6%, and that means that earnings have to be downgraded. And I think that's what the market's trying to adjust to is lower earnings. Not just for this year, but expectations going into 2025-26, where we're thinking that EPS growth will be maybe between 5 to 10%, but let's say 10% more optimistically. So therefore, the index could rise along those kind of lines in 25-26. But all of this is irrespective of what we're thinking regarding Trump. But when Trump comes in, all of this could change, and I think that's what the market will have to grapple with. Not just our markets, but global markets as well. So sitting on the sidelines having cash, I think is a good strategy just for the very short term.
Okay, sit on cash. Cash could be a position in this sort of uncertain times. Hi, Andrew. Good morning. Good to see you in. What about the Indian markets? When you joined us last time around, you said at these valuations, at these levels, you're not very, very excited. And the US market's the main game in town, with Trump taking over. We are a little bit lower in comparison to what we spoke, when we were in November itself. I think we're around 5 to 6% lower in comparison to those levels. How much lower for you to get excited on the Indian markets?
So I think if the market was to fall another, say, between 3 to 5%, I think valuations will start to become a little bit more compelling. Listen, we'll get into oversold territory. We probably are in the bank index at the moment, and you could see bounces. But if your expectations are that forecasts are going to have to be lowered as this quarter unfolds, then 3 to 5% is probably what I'd be expecting anyway in earnings revisions. So that would be in line with the market fall as well. So At those levels, I'd be a little bit more optimistic. But there's no real catalyst, right? Unless the government starts spending money, which it doesn't seem to be opening its purses at the moment, then there's no kind of multiplier effect going into 25, 26 for the economy. And therefore, you're seeing a lot of more negative reports about either a K-like kind of recovery and consumption, or big slowdown in capex. So all of these factors, I think, are just playing into the negative views where valuations don't support you.
Yeah, no, absolutely. Point taken. I'm just looking for anything which is moving in a meaningful way. So yeah, I mean, it's all actually the leaderboard with volumes is all dominated by IT services, TCS, Infy, LTI, Mindtree, Coforge, Wipro, Persistent, Tech Mahindra, and so on and so forth. Keynes is making a bit of a move higher, 1.5 higher. And then there is something like an Amber, which is up about 1.25% as well. Can't see Dixon anywhere, at least not with volumes at this point in time. Andrew, hi, morning. The entire renewables space, if I've spoken, I don't know if you've spoken about it before, or if you have a view. Solar especially. Now you've got more than a few listed players out there. Anything you own? Do you have a view out there?
No, not really. I think, in terms of the whole kind of renewable sector and power in particular, we know expenditure is going to be there. So we know it's a long-term play. But, I don't think there's any real catalyst, again, for these shares to move higher. I think it's going to be a little bit more competitive in the short term. So staying away. I think what we're trying to think about, Prashant, is where will currencies and where will bond yields go in the short term? Because that, I think, will give us a good idea of what global markets might be facing in the kind of first quarter of this year once President-elect Trump takes over. So I think that will give us a good clue of where foreign investors will also be will they be coming back or not? So, for example, if, say, the China tariffs were not 50%, but 30%, I think that would be good for emerging market sentiment. And if China was to throw in some stimulus as well, then again, flows would start coming towards emerging markets. So these kind of things that you have to watch out for. At the moment, the dollar index is telling me that's not going to be the case. But as I said, it could be a more tempered approach by President-elect Trump than the market is anticipating at the moment. That's why I'm saying I think just wait till after the 20th. I think we'll get some clarity on what his proposals will be, and as we've probably seen in the last few days, they can include countries as well as tariffs.
Absolutely, we don't know Greenland, Canada, tariffs. Who knows what's coming? And the 20th of January is just the start. We must remember, right? It doesn't end. There's no crystal clarity by the night of the 20th of January. We're on a roller coaster here. And Andrew, we will look forward to having you on back with us on the roller coaster in the coming weeks as well. Thanks very much for joining in. Have a good Friday. Okay. Well, the market has kind of settled out now with the large caps doing better than the mid caps. By the way, there's a deep cut in the mid cap market, and that pain has really extended early in the morning. You've got a 1% decline on the mid-cap index, while the Nifty is okay, thanks to the fact that, IT is still contributing. But this screen is now telling us about the broader pain, which is still existing out there.
It's breaking down, right?
Yeah.
It's very, very clear.
Structure is weak.
The structure is weak and gains are not holding. We're absolutely now flattish. Look at the Nifty Bank. And that has been the weaker of the indices. It's basically broken all key support levels. And it's down 200 points now. That's about 0.4% knock. 49,296. And as Surabhi pointed out, the broader markets are also now starting to roll over. That was not the case so far. 400 stocks are higher and about 1,900 stocks are lower at this stage.
And Prashant, just one more point. You have the Nifty Bank that is struggling today.
Yeah.
And all of last year, you're blaming it on HDFC Bank. Today, you can't blame it, because HDFC Bank actually is holding one end up. So, and that's the largest constituent in the Nifty Bank. And that's actually holding mildly in the green. So, it's X of HDFC Bank that is seeing some kind of pressure. But with the kind of selling that you're seeing on the Nifty Bank, it's due for a big bounce. Just because of the one-way move that you're seeing. 51,500 a few sessions ago, we're at around 49,000 odd. So we're due for a bit of a bounce. Let's see whether or not we get it today or we get it, sometime next week. But we are very much due for a bounce, particularly on the Nifty Bank, and that's been the underperformer.
But you know, all through last year, we were talking about how foreigners are not coming or foreigners are selling, and that's why banks are not performing, particularly HDFC Bank. Now we've come to a time when you wake up in the morning and you'll find some brokerage or the other talking about how the best for banks is now behind, now EPS cuts are ahead. This morning it was Goldman Sachs saying that expect more EPS cuts and margins have peaked out. I mean, we have not even started the beginning of the next credit cycle. And then, you know, you have so much of chatter coming through and then,
credit growth was running at 18-20%.
Yeah.
Now it's 5-6%.
Exactly.
So that's clearly, exactly. I mean, there is that slowdown, which is very, very evident out there. Absolutely. But let's talk about the oil and gas space as well. And our colleague Sapna is joining in. Sources tell us that the Petroleum Ministry is seeking 35,000 crores for LPG under recoveries for oil marketing companies. Sapna is joining in. She's been reporting on this story over the last couple of months. Sapna, over to you. Morning.
Morning, Prashant. So, yes, absolutely right. This is the amount that has been sought, though it's being indicated that the under recoveries by the end of the financial year could be higher because CP Saudi, that is the benchmark for gas pricing, those prices have been elevated the entire 2024, and now with the winter onset, that elevation could actually continue. So, despite the under recoveries being higher than what has been sought, this is what is the expectation, at least from the Petroleum Ministry. Now, OMCs are, have been seeking this kind of support. If you remember, if you recall when the Q3 results had come out, this was one of the major pain points due to which their earnings had been impacted. So 35,000 crores is what has been sought. Given to understand that this money that has been sought, the cash compensation, this could also be in two tranches. So if we assume that the entire amount will be okayed by the Finance Ministry, and that could be an indication for the coming budget, maybe not, I mean, in principle, the full amount being okayed, but the flow of the cash compensation coming through in tranches is what we have been given to understand. So assuming 35,000 odd crores is where the buck will stop. IOC being the largest, more than 50% will go to IOC and the remaining will be shared between BPCL and HPCL. We'll have to wait and watch and see how this pans out. There's another element to this entire thing. Given to also understand that when the OMCs received the compensation previously for during the just when the Ukraine crisis had broken out, around 28,000 crores they had sought and 22,000 crores as cash compensation was given by the Finance Ministry. Apparently, there was also a demand of GST on that amount that had been given. So this time, the government is likely to calculate it in such a way that the entire 35,000 crores accrues to the OMCs and there is no tax liability on that side. So that's the second aspect that we have to look at. Of course, we'll have to wait and watch and see how this pans out, if anything comes at all in the budget or not. But 35,000 crores it is as of now being sought by Petroleum from Finance for compensating OMCs for the LPG under recovery.
All right, Sarna, thank you very much for that. That's an important story. We will continue to put the spotlight on. Well, let's move on. Markets, of course, struggling a little bit, down about 15 points. But let's talk about the real estate space. Now, we've been kind of putting the spotlight on real estate as a space over the last couple of days. And, we've had real estate consultants. We've had a couple of companies join us over the last 48 hours or so. And, everybody's been kind of pointing to maybe the first signs of some slowdown as far as residential real estate sales are concerned. Remember, we've had a fantastic boom in the residential real estate segment, especially ultra-luxury segment. Remember, according to Anarock, and we put this data out earlier as well, 59 ultra-luxury homes worth some 4,000 crores were sold in 2024. Value terms, it's about 17% on top of what we saw the prior year. But let's get some perspective from a very large real estate player. Abhinandan Lodha, chairman of the House of Abhinandan Lodha, is joining us here in our studios. And we'll also have Santosh Kumar, Vice Chairman of Anarock Group, with us. Gentlemen, great to have both of you here in the program. Abhinandan, good morning. Great to see you here in our studios. And I think we are speaking for the first time maybe in this program. So, pleasure. Just that point, Abhinandan, it's been fantastic. First of all, let me tell our viewers actually that Abhinandan Lodha Group is the largest branded land player in the country. Right? So you focused on the land side, you don't sell flats.
Yes.
You sell plotted development, real estate in that sense. So the actual stuff. How has 2024 been? Just a bit of background. and tell us how is 2025 and beyond looking. It's such an important sector. I mean, real estate per se. And that got fixed a few years ago, and that sort of, showed up in so many other places. Now we are starting to hear the first signs, maybe some slowdown is emerging. Your thoughts?
No, I think generally the real estate sector, as you rightly said, has a very large role to play in the economy. And it is also almost incongruent to the economy in that sense. I think 2024 and the year precedent to that, both were quite exemplary years. For example, the House of Abhinandan would have started development activity on the plotted land side only in 2022, 2021. And I think what we've seen over the last 2.5, 3 years is sustained demand rise across the country. And we are now present at 11 locations across the country. So it's not that you're seeing more in urban area or less in rural area, right from Vrindavan to Neral to Konkan to Ayodhya ji, there's great amount of demand everywhere. I don't see at this point of time any indication of a slowdown coming on that segment. In general, there is I think some conversation around the super luxury segment having seen a lot of buying. I don't see the demand there coming down as well. I think what might have happened at this point of time is that the supply in some of these places, which was very, very clearly visible, say 3 months ago, of under construction properties, there the prime properties may have already gotten taken up. So I think the super premium buyers may be waiting a bit on the sideline to see new supply coming in. But in general, I think the demand for real estate will see a significant uptick over the next 2 to 3 years. While pricing may move from region to region, in general, the demand capacity absorption at this point of time is quite high. The demand continues to rise. As the economy does well, people make more and more money. The desire to participate in housing also increases. What we are seeing more and more on the land side as well is that generally people have recognized that land is equal to wealth.
And we'll come to land in just a bit, Abhinandan. Just to complete that point, you said economy is doing well, people do better and better. That's the trajectory over the longer term. But we are struggling a little bit now. I mean, growth has come off a little bit, 6.5%. More importantly, stock markets, which has been so important, at least, and I've put that to many real estate developers. How much of this boom in real estate is being fed by this boom in stock market, because so much wealth has been created there? That is also kind of tapered off a little bit last 6-8 months. So just tie in those two aspects as well.
And Abhinandan, if I could throw in one more data point that we picked up this week as you give us your answer to this. Like Prashant was saying, we spoke to a bunch of consultants earlier as well. Knight Frank gave us a data point and that really stuck in my head. And that was a data point for Mumbai particularly. What they've noticed is in the 50 crore plus 100 CR super luxury premium housing segment, things are still fine. But what they told us is that in the 20 CR to 50 CR bucket, houses worth this much, that's where in Mumbai there is already inventory worth 5 years, which is already there. That's the stock that's already there. So could that be a bit of a worry, coupled with what Prashant is saying, that stock markets are now far more muted?
So I think it's a mix of two things. If you look at this months of inventory concept, it's a great concept. But if you go back 3 years in time, people were under the belief that we've got almost 10 years worth of supply under construction in Mumbai at a given point of time, which very quickly moved from 10 years to less than 18 months. The 20 to 50 crore rupee segment, I think if you go back 12 months before, you see most of the supply got announced only in the recent past. So while it seems like a lot of supply today, you will see a lot of absorption happening over the next 2 to 3 years, where again you'll see a supply-demand mismatch. Generally, unless and until FSI norms change, oversupply situations are very, very difficult to create in urban areas. So wherever you've seen oversupply situation actually getting built in Mumbai, that was probably when you had the FSI changing from 1.33 to upwards. Now with the uniform DCR already out till 2034, people are reasonably aware of what is the possible building which you can create. So I think on that perspective, if you'll date that back to the announcement of supply, you'll see that the supply-demand lag is very indicative of the fact that people will now start picking up this inventory because they've now probably reached a stage of construction which makes people comfortable to buy.
So you don't see any oversupply in the Mumbai market?
Not at this point of time, no.
Okay. Just on the stock market relation and the point. 3 years back, by the way, Abhinandan, I was just looking, Nifty was at 15,000. It's not a direct correlation, but you know what I'm getting to. Yeah. What's your sense? Is that the wealth effect, right?
No, I think the wealth effect definitely has an impact, especially when it comes to the absolute upper end of the market. What I really don't have an understanding of, and probably you would know much more, is that I think a lot of money has already gotten made and people have not necessarily taken that money off the table. And what my limited experience tells me is that when people feel that one asset class sort of maybe plateaued for some time, people tend to take money out of that asset class and put it into the asset class where they can either use or they can see the next level of indication uprise coming. So I think from that perspective, while people have made significant amount of money over the last 2 or 3 or 4 years, I don't think too much money has already been taken off the table. There is a sustained amount of retail money coming into the country. So at the upper end of the market, as people sort of start encashing their gains, you may see actually one more wave of the upsurge coming before at any point of time you see sort of momentum going sideways.
All right, Abhinandan, since we're just talking about markets, real estate as well, I just want to put this question across before we go to Santosh. Plans of listing?
No time soon. No time soon.
Not yet.
Not yet.
No. But in the next few years, that could be the ultimate plan?
I would hope so, yes. I would hope so. I think as the business reaches a maturity, we would definitely like to take part in the value and also create value for all our stakeholders, but not in the near future.
So maybe in the next 3 years or so, that could be a 3-year plan?
That could be, yes.
All right. We'll come back to you, Abhinandan. Let's get in Santosh Kumar, the Vice Chairman of Anaro Group, who joins in as well. Hi, Santosh. Good morning. Thanks a lot for waiting by. Well, what's your take? As you've mentioned in your note, that 2024 was a super year for ultra-luxury housing. How are things shaping up as of now? Initial feelers that you're getting for 2025 and how you expect the year to shape up?
Yeah, like Abhinandan mentioned, Prashant, the Indian real estate sector, even in 2025, is poised for a robust growth. Primarily because there's a stability, there's a favorable demographics, and also there has been a lot of government reforms. And we do expect, in the forthcoming budget, we see there should be some positivity for the real estate sector. With the GDP growth, even though the projection is for a little bit of lower growth this year, but urbanization and demand for both the residential and commercial continued to sustain that momentum which was there in 2024. So we believe that this will continue even in 25. And like Abhinandan mentioned, stock market growth, some of the the businesses which have been really doing good, the startup ecosystem is really pushing the demand. The money is coming in, and some of the government initiatives are also supporting the demand for the real estate sector. And there are different emerging sectors like co-living spaces, warehousing, data centers continue to drive the investment opportunities.
Got that, and fair points, Santosh. Abhinandan, so let's come to what you do, land, right? I mean, we're talking about residential real estate overall, but is owning land as a concept? I mean, for the longest time, it was a tough thing to do. You had to have access. You needed. I mean, only wealthy people with connections, access could think of buying land in some far-flung place where you're not. I mean, proximity was very important. As you've showed over the last 3-4 years, that is not really the case. You're trying to do something different. Tell us, I mean, what are the trade-offs between owning land versus, actual real estate, and how's it looking?
So I think in terms of the underlying value creation in real estate, I think land is really where all the value gets created. And I think an indication of that is the current redevelopment movement in Mumbai. So there's somebody who's willing to take over an existing building, give the tenants more space, and still create value for himself by creating extra saleable area, which all comes out of the fact that as urban limits change and as cities mature, FSI norms change, locations change, and land becomes more and more valuable. And I've seen all my life, and I think maybe most of us have enough stories around us, where people who've sort of invested in land and were able to hold on. Imagine holding on to an acre of land in Thane or Gurgaon 20 years ago, and the value creation is created today, right? And I think
Nigel would be on an island somewhere.
And I think that the fact is, I think the Indian psyche recognizes the value which land can create. And most of the people who unfortunately were not able to access land due to the issues around possession, title, ownership, how do you keep it safe, how do you get approvals, and how do you resell? So I think what we've managed to do is we've managed to build our entire business on the back of a tech platform, where till date we've not had a single in-person consumer interaction. Across the 11 locations that we are present today, every single piece of land that we've sold has been sold across the screen. And what that enables people to do is it's almost like buying dematted land. You're sitting anywhere in the world, you believe that Vrindavan or Shimla or Mumbai is going to do great. You got now access through somebody who's got credibility, and he's sort of assuring you on title, possession, approvals, and resale, all 4 of those things. And because of that, what we've seen is the kind of buyer profile which is now coming in. 27% which people buy are buying from outside the country. 70% of the people buy from outside the state where you're launching, which was probably effectively impossible till, say, 3 years ago. And that juxtaposing essentially means that as long as you got a view on India, I could be sitting in Hyderabad, and I understand now that what happened in Hyderabad 4 years ago, where I've seen the real estate boom, maybe missed it, is now going to happen in Nagpur because of the kind of development which is happening there. And I don't need to physically go to Nagpur and try and buy a half an acre piece of land. I actually now have access across my screen. As long as I take a call on the macro environment of the country and the micro environment of a particular region, access is getting created and people are wanting to participate in land like something we've never seen before.
A very, very interesting point you're making out there, Abhinandan. But tell us, if you had to pick out the most promising market, which one would that be?
I think Vrindavan offers fantastic value proposition at this point of time. From a cultural tourism perspective, great luxury has not come there. The amount of people wanting to participate in land there is extremely high. And Shimla does the same as well because there's no supply in that place. So if you're able to get on supply in a region like Shimla from an investment perspective, I think Vrindavan, Shimla, and then I think Ayodhya ji's got a long-term story playing out for the next 10 years sustainably. I think between these three places, if you're sort of able to take a bet on investment and wait patiently for 10 years, you'll see the kind of return which Gurgaon or Thane have created for most people.
So Vrindavan, Shimla and Ayodhya.
Yeah.
I wonder where's the land left in Shimla. I mean, you start climbing up that mountain, all you see are houses. But there is, I don't know where the land is. But just to complete that point, and it's very interesting that you brought this up, I just want your thoughts on the way the overall industry is growing. We've got REITs, now we have smaller REITs, but these are entities which will be looking at annuity-based returns. So they'll be looking at commercial spaces or, maybe, specific aspects like data centers or warehousing, which Santosh also said. So when it comes to more individual ownership of land, do you at all see REITs playing a part, or will it be independent developers like yours? I mean, how do you see the industry evolve in terms of real estate as an investment asset class, something that financial planners have always been advising against because it's fraught with risk, it's high capital, and there's just too much at stake?
No, I think I've seen a lot of my wealth management friends sort of talk of having real estate in your portfolio, but they refer only to apartments. And I think apartments, while you can take some exceptions out, have given sort of single-digit returns over the last 10 years on a sustainable basis. I think land returns are fantastic. So I think if you're able to provide that comfort to people, a lot of people would be able to participate in land. And I think it is not the real estate investment cycle will have sort of co-investments happening. I think you'll have fractional ownership taking place. I think you'll have people participating in REITs, but they will probably be, I would say, larger in size. And I think land will become a far more important horizon on the investment cycle. I think at this point of time, less than 2% of the investment in real estate moves to land. And that number will significantly change over the next 5 years.
Well, that's only for the big fish. Let's actually bring in Santosh's view on this as well. Santosh, do you concur? Do you see more broad-based ownership of real estate assets and land? And also, will it be only reserved for the ultra HNIs, or do you see this coming down the curve?
Oh, I think majority of the developers now coming out with the smaller plots, which definitely attracts the smaller investor. I think the outlook for both land and developed property is promising. Land continues to be a valuable asset, especially in the urban peripheries and tier 2 cities. Like Abhinandan mentioned, where developers are actively acquiring land parcels to meet the rising demand. Investment definitely comes with some of the risk, but growing trend of institutional investors focusing on yield generating assets like office spaces, retail malls, but the plots and land continues to give them the higher return as compared to developed properties.
Right. By the way, Abhinandan, when we talk about returns, asset classes, we always look at sensex. What has gold done over 20-year bonds? But land, of course, it's all because it depends on what you buy, where you buy, right? But in any sense?
I think in general, if you're buying land from a 10-year horizon, and I think this is evidential data I'm happy to share with you, in any semi-urban to urban area of the country, if you're able to hold on to land for a 10-year plus period, you'll make 24% plus compounding return.
24 CAGR.
Which is by far the best return you'll see almost in any asset class. The idea is how do you ensure you hold on to the title and the possession of the land and make sure it is being bought with the ability to maximize after time.
Wow. By the way, we're already getting queries. Please ask Mr. Lodha where in Maharashtra.
Yeah, where in Maharashtra?
So we are present in Khopoli, Konkan, Neral, and
That's looking good.
Yeah, I think Khopoli is a great belt. I think from the value proposition it provides today, especially for somebody looking for consumption-based buying. So sort of you buy a piece of land today, and that also is large value creation land, right? So what we've seen is people are able to buy in Goa a piece of land at 5,000 rupees a square foot. They are able to hold on till delivery. They can sort of build a bungalow on top of that at 6,000-7,000 rupees a square foot. And then the resale is at 30,000 rupees a square foot.
Oh.
So the value creation which land does in the mid-term actually comes by change of usage. What it does in the long term is by change of FSI and change of city norms.
I must say, being a journalist, I must put on the table the caveat here that you must know your own risk appetite, right? It's not for the faint-hearted. It's not, you can't liquidate suddenly if you need, your maybe 50 lakhs back. Or can you? But you're saying that it's all becoming screen-based, but quick question, ticket sizes and ease of liquidity. Ultimately, it's a hard asset.
30 lakhs to a crore is the general ticket size which we deal in.
Okay.
So I think from that perspective, it's quite okay because leverage is available as well.
Okay.
And I think resale today, at least on our platform, we are able to provide resale to 98% of the people who put it out for resale.
Oh, wow.
Okay.
Because people, like you said, have different risk appetites. So some people want to buy at the start of a cycle.
Yeah.
Some people want to buy when the cycle is completed.
Okay.
All right. We'll leave it there. Abhinandan, great chat as always. Thank you very much.
Thank you so much.
Look forward to our next one. Santosh, thank you very much for being with us here as well. So that is real estate in focus. And, we were talking about money moving, and Abhinandan made that point. Maybe, that one, not last push, but maybe there is this one wave which is left as markets start to, realization sets in that maybe one asset class is starting to consolidate a little bit, won't go boom, boom. Maybe some money will come out and perhaps, look at other opportunities, etc. I mean, case in point, 100 points lower this morning on the Nifty, 23,420 is where we are at. Surabhi? And this is not just, we've of course broken the earlier lows of this week, we've broken last week's lows as well. Yeah. So the slide is just, it's so the December 31st
relentless.
low was 23,460 and now that is gone. So 23,416 at this point in time. We'll take a quick commercial break, more sort of in terms of stock spotting on the other side, but we'll also talk about another interesting space, which is of course EMS. Keynes Technology Management will be with us to talk to us about how 2025 is looking like. Stay with us.
Any kind of bounce is getting sold into, and that's evident on the screen. The Nifty is at the low point of the day. The Nifty Bank as well tried to stage a bit of a pullback. We are holding around that 49,000 odd mark, but those bounces are getting sold into. So as of now, that dip has not got bought into. And one stock that we had highlighted earlier today was KPIT Technologies. Tata Elxsi is seeing a lot of selling pressure, and KPIT Technologies as well has got a little bit, the investors out there are a little bit nervous because of Tata Elxsi, which belongs to a similar space, has come out with a big set of numbers. So that's why that's down 4.5%. Let's focus on a couple of other themes then. EMS, that's the important theme out there. And some of these stocks have seen some selling pressure. This after Tata Electronics has got the CCI clearance to acquire majority stake in Pegatron India. What does this mean in terms of competition? Will the intensity go up? Well, we're joined by Mr. Jairam Sampath, the Director and CFO at Keynes Technology India. Hi, Mr. Sampath. Good morning. Thanks a lot for joining in. Wishing you, as well as your team, all the best for 2025. The theme in terms of EMS is sounding very, very interesting. However, the markets are a little bit nervous that there could be additional competition coming in there with the entry of the Tatas. What is your take? Do you believe that the pie is big enough for everyone to get into, or do you believe that this will pose some bit of a challenge?
Anyway, good morning, and thank you for having me on the show. Fundamentally, anybody interested in the industry and putting up new ventures is a positive sign for the industry. So market and the pie was already large enough. It was just that the foreign players were taking a huge share out of this, and then Indian domestic players were probably not participating. So now that trend has kind of reversed, and you have a lot of people in India trying to partake from the import substitution, let's say, trend. And so it's a good thing. Also, in a marketplace, you need to have many players, especially world-class players, always welcome, so that India as a destination for manufacturing gets recognized. And that's very important because there are only small differences between companies across the world in terms of their abilities. So it's the attention that makes a lot of difference in terms of making you kind of ready for attention from the OEMs and so on, and the RFQ. So nobody does a complete census survey of market before they award contracts. So they go by a top level understanding, and then they shortlist a few players and so on. So it's very good news that there's continued interest for investments into India across the various sectors.
All right, Mr. Sampath, so just clear the air. You're saying a new entrant actually could be healthy for the industry, and you don't believe it's a risk because the pie is big enough. Are we getting that correct?
Yeah, absolutely.
Okay, all right. So that we take that on board. But there could be an element of pricing pressure, more amount of players. If you have a client, they may want to go to another one. Could that be a possibility, or do you think that pricing power exists for the industry?
Yeah, so pricing pressure, pricing is a function of demand versus supply. So the margin pressures, as people imagine, will be higher if the supply is plentiful and demand is less. But in case of India, it's the other way around, especially supply of indigenously manufactured electronics pretty low compared to the demand. And so also in the newer areas of electronics, like semiconductor, advanced assemblies, and so on and so forth. So there are a lot of areas where demand exceeds the supply. There could be government projects and so on. So in such cases, the margin pressures generally don't make themselves visible. So margin pressures have not much to do with the number of players. It has something to do with the nature of the industry.
Mr. Sampath, hi, good morning. Great to have you on the show today. So I just want to talk about now, as an industry, what do you need additionally from the government? We've already seen PLI schemes for mobile phones, for IT hardware. There's a lot of expectation. Our colleagues have also been reporting that this new 25,000 crore rupees PLI scheme for electronics components, I mean, that would be there. It'll cover things like maybe printed circuit boards and maybe camera modules, so on and so forth. How successful have the PLI schemes been so far, and what further tweaks would you want? What would you want to hear in the budget and beyond that can really make the Indian EMS industry fully competitive and make it fully realize its potential?
Yeah, that's a very interesting question. See, firstly, the thing that's required is government must follow through its plan of doing localization of imports. And that, to my mind, government doesn't have to spend too much money. They just have to nudge the OEMs, the global players who are selling into India, to look at India as a base for manufacturing. So it could be varying levels of, let's say, value addition, but that probably will do the trick faster than any other PLI. In terms of PLI and other schemes, I think they are good to begin with. Maybe a first few years of industry setup, they kind of take the edge off the margin pressures. But then eventually, government must make sure that it encourages companies to invest into newer technologies, and it must follow through its plan for what is known as Atmanirbhar Bharat, and especially in the emerging areas such as electronics and high-tech manufacturing.
No, so on PLI, I mean, just give us your experience from Kane's perspective. How much have you benefited from the existing schemes and the contours of the new scheme that's being now discussed? 25,000 crores of a PLI scheme for, like I said, for PCBs, for some sort of, other system assemblies, for camera modules. Does this sound good enough? And what about the thresholds? Like you said, the thresholds for localization, maybe they'll be increased. So, how will all of this play out?
Yeah, in certain, let's say, component categories like PC board, I think it is very helpful because we have a very minuscule market share compared to the global players like China. So it will definitely help to move a lot of production into India. And so, like I said, PLI schemes in the beginning stage, especially in these kind of components like PC board and other components, they'll be greatly helping in establishing manufacturing facilities in India. So I think it's a good thing that government is thinking in this direction. And these are essentially, I say, positive moves instead of putting just tariff barriers, I think they are going one step further, and then they're saying that if you make in India, you get some little bit of benefit. Our experience has been that the PLI, especially in the industrial production, it does not account for a huge amount of, let's say, influencing factor, because PLI schemes by and large are visible. And so while they make the total cost of electronics production in India lower, but they may not specifically benefit one company or the other. So from that perspective, they are more a systemic, let's say, dose of medicine. What I think is even more powerful is to move the demand into Indian, let's say, Indian companies. So by various means, by using the Atmanirbhar Bharat plank, so that will probably do this entire thing far superior, because there are lots of areas where government is a large buyer and also a large influencer. And also, I think we must project positively the future demand potential within India for both consumer as well as non-consumer areas. Our non-consumer areas like industrial and other areas, also penetration of electronics is quite low. So we are actually just in the beginning stage of this entire revolution. As I say, of course, there's always a lull before a storm. So what you see today, as sometimes, there is a bit of a lull because of elections and stuff like that. But let's not get fooled. I think we are in for a very aggressive growth in this particular area. Because that we see from the kind of RFQ that you get and kind of footfalls and the percentage of occupation of our conference halls and so on.
Yeah. All right, Mr. Sampath, we're running a little short on time, but since you mentioned PLI and the government support and the way forward, and you're not shying away from the fact that there's a tremendous runway for companies like yours. But I need to ask you on this PLI aspect. You have Dixon, Foxconn, and the last week or so, we've been hearing about them coaxing the government to please clear their PLI dues. With regard to your company, what is it at? What is the total PLI dues? When do you have to receive it? And have you received what you'll have asked for till now?
Yeah, so we have very small portion, less than maybe about 7-8% of our business wherein PLI is applicable. So from that perspective, it does not hurt us. But I do notice that if you compare the incentive payouts today compared to, let's say, 4 or 5 years ago, it's much faster. But then obviously, if some industry players are coming out and saying, please do pay fast, I think that also reflective of the fact that in their total profits, PLI is in significant proportion. So I think government can definitely do it faster and set up mechanisms to more upfront these incentives so that the benefit is not lost. So whatever incentives are given much later do not spur the demand as much as if it is given on time. Because if it's given on time, it gets reinvested into the business. But it's given very late, it goes into some buckets, So I think the players are asking rightfully to give this so that they can maintain their profitability and the positive outlook.
Got it. But Mr. Sampath, but have you received what you have asked for till now? Or is there a
see, so far the movements have not been bad. We have just in IT products, which is the servers, etc., and then also in some white goods electronics. And it's a very small amounts, and so we are receiving. It's not that we are not receiving. Even in the new projects where there is capital subsidy, there's a fair bit of say transparency and movement of files, etc. So we don't see any major issue here, but maybe it's also reflective the fact that how important PLI is for certain companies. So obviously their let's say levels of anxiety will be higher than companies like us.
Okay, all right, Mr. Sampath, we appreciate you joining in, giving us an industry view out there. We're seeing this tremendous growth, new player coming in there, so there's big potential. And with regard to the PLI, you'll be happy to see the PLI payments coming on time for other players as well for the industry. What's promised should come on board. When we have you with regard, post your Q3 numbers, we'll get more details from you on your company. But thanks a lot for joining in. Well, by the way, when we're having that chat with Mr. Sampath, just pull up the intraday chart of the Nifty. We've moved to the low point of the day. We're down 160 points. The Nifty Bank as well is now down close to 600 points. So those bounces are getting sold into, but that's not telling you the picture. Advanced decline ratio, you have only 190 stocks that are advancing as of now. So, a little bit of caution would be warranted at these levels, given the kind of fall that we've seen in the first hour of trade. Slip into a short break, come back. Manisha Gupta will focus on all the commodity-related stocks.
Welcome back. Continues to be yet another tough morning for the markets. Take a look at what's going on. It's a 150-point decline, one-way decline on the indices right now. The mid-cap index has slumped over 1.5%. The advance decline ratio is extremely negative. Just about 190 stocks advancing. You've got over 2,000 stocks declining. Very weak. It's a breakdown that we're seeing once again. And barring IT, really, there's nothing else in the market that's holding up. So let's actually go and revisit that silver lining, which was TCS. TCS came out with solid commentary, though the revenue growth was, of course, a bit muted for the third quarter. We have Rima joining in with the 5 reasons which are powering up the stock today. Rima.
Well, the first one is the stock has been an underperformer versus peers in the last 1 year. Taking into account today's rally, in the last 1 year, TCS share price is up 13%, but its other large cap peers have rallied close to about 30%. Secondly, because of this underperformance, stocks like Infy caught up with TCS in terms of valuations. Historically, TCS always commanded a premium for its solid execution, its size, but now Infy and TCS both are trading at 27 times forward multiple. Reason number 3, while Q3 revenues admittedly are a miss, you would still classify them broadly as, inline numbers, and there were no EPS downgrades that we saw. And the fourth and the more important reason is the deal wins were strong and the management commentary was upbeat. The deal wins were in a range of about $8 to $9 billion for the prior 2 quarters. They went up to $10.2 billion. And here the management speak, seeing an improvement around discretionary spends in BFSI and retail. The deal cycle, basically decision-making, has shrunk by a few weeks. The current sentiment is more positive going into this year. FY26 should be better than FY24. And even the initial conversations, client budgets have not closed, but the initial conversations suggest a positive bias. And here's how brokerages have reacted. CLSA has upgraded the stock to an outperform. The new target price stands at 4,546. The reason is valuations are now attractive relative to peers and even versus its own 5-year history. And they're now forecasting a 14% EPS growth for the company in FY26. Jefferies is a buy call, but they say, again, valuation at 27 times is attractive and factors in near-term growth headwinds. HSBC has a hold call, but they do say performance seems to have bottomed out, though they do see some downside risk to FY26 consensus estimates.
Okay, all right, Rima, got that. Thanks very much. So TCS continues to be the support for the market. Not that it's helping too much because there is a wide slide that is underway as of now. In fact, Rima, before we let you go, let's also do a quick check on Tata Elxsi. I mean, Tata Elxsi came out with obviously really weak numbers and the stock's reeling under pressure as well.
Now it's been a couple of quarters of weak numbers from Tata Elxsi. The stock is down 31% in the last 1 year. Last year, it was a big underperformer, and despite a 25% fall last year, it's fallen a little bit more today. And now the 3-year returns have been eroded for Tata Elxsi. The problem is valuations are high for the company at 40 times, but growth is not at a premium to peers. Look at the estimates by the street. For this year and next year, the street is penciling in single-digit top-line growth. For this year, closer to 5%. For next year, closer to 9%. So that's the problem. High valuations when growth is not at a premium. And also, if you remember, just 3 months back, the company said that FY25 growth should be better than FY24. But 3 months later, that's impossible to, it's close to impossible to achieve because in 9 months, they've clocked in a 5.7% growth, less than 10.1% that they had in the prior quarter. In Q3, growth has slowed down. Flat growth quarter-on-quarter, year-on-year growth has decelerated 2%. Margins have missed street expectations, and margins are much lower than the 28-29% that they used to command. And the problem is the transportation vertical in Europe and US, which is about 50% of their overall revenues, that has slowed down. Their clients are facing some challenges. And that brings us to KPIT Tech. Because while Tata Elxsi gets about a 53% revenue growth from the auto companies, KPIT is 100% dependent on the auto companies, and this has also been an underperformer. This stock too is down 32% in the last 1 year. We'll get clarity on the 29th of January when they report their Q3 numbers. But this is also a stock which, growth headwinds are visible. Last quarter, they told us that growth for this year will be closer to the lower end of their guided band of 18 to 22 times. And valuations, though, have derated. It's still at 40 times forward multiple. Back to you.
All right. Thanks very much for that. So those are the two tech stocks in focus today. IndusInd Bank is also down. The whole market is down. The Bank Nifty is down. But IndusInd has fallen the most today, and that's on the back of Goldman Sachs. Remember earlier I was pointing out about a wider sector note that GS has written. GS is very circumspect on banks in general and IndusInd Bank in particular. Abhishek, tell us more.
While Goldman Sachs has written on IndusInd Bank, they have downgraded the stock to neutral, cut the target price to about 1,090 per share. They have cut EPS estimate by 5%, 16% and 18% for FY 25, 26 and 27. So they say that revenue engines have slowed down for IndusInd Bank over the last 2 quarters. They expect that to get further impacted due to rising delinquencies that you are seeing with respect to commercial retail loans, especially the MSME and CVs, and slower loan growth as well. So having said that, they say that the valuations have corrected quite sharply as investors have moved away from price to earning to price to book value multiples due to limited near-term visibility with respect to the earnings trajectory post Q3 earnings. So they say that the stock is currently trading at one-time forward multiple, that is FY26 price to book value, which seems fair for the kind of ROA, loan growth as well as ROE that they estimate on IndusInd Bank. Back to you.
All right. Thanks very much, Abhishek, for that. With that, let's now move on to the commodity markets. Equity markets obviously are reeling under pressure. Let's see what's happening in commodities. Manisha, what's the news?
Well, I'm looking at the best gainers in 2025 for now, and this is purely because of the impact of rise in US tariffs that the markets are working with right now. I'm talking about silver and copper. So when you look at the previous year, we saw silver prices gain up by 23%, and today is 10th of Jan, and we already are up by nearly 5% for this year until now. But the better gains clearly are coming in for copper. Last year, it gained 6.5%. The first 10 days of January, it's up by 8% already. So clearly the best performer that you are seeing in 2025 till time comes in for copper. Markets are anticipating or betting all-time highs to happen in copper for this year. But to begin with, this is purely an impact of the expectation that the US tariffs will rise. So in last 5 weeks, we've seen 15 million ounces added to the US COMEX warehouses. This is in the anticipation that you will see prices going higher. Well, remember, US is the largest importer of silver, and US does import silver from Mexico, Canada, Turkey, and US is looking to increase tariffs when it comes to Mexico and Canada. So this is exactly a precursor or a pre-reaction that we are seeing into the markets right now. Also, when you look at the LME warehouses, well, they have continued to drain down as well. Remember, it has been 4 years that you have seen global silver markets in a deficit, and with the US buying like it's buying right now, silver absolutely in limelight right now. That's exactly what has been happening for copper as well. The markets are absolutely getting divergent here too. The LME prices in copper gained up by 1% overnight. It's trading at a 3-month highs right now. But that is LME, that is London Metal Exchange. When you look at the US exchange, which is COMEX, the prices there also are trading at a 4-month highs. We've been looking at prices gaining a 1% average every day in all of 2025 till time. So this is happening because the markets are attempting to discount or rather look in to the hefty tariffs that the street is anticipating going forward. So when you look at the COMEX markets right now, when we started this year, the discount was almost like zero. But right now, COMEX is trading at a premium of $400 to LME. I mean, that's the kind of buying or demand or anticipation of tariffs that the pricing is happening with. Also, when you look at the COMEX LME stocks, well, they are at a 6-year highs. They have gained up by 10% in 2 months. This is all because of the more copper coming in for US right now. The markets also are looking at higher imports that continue from Chile. That is where US gets 60% of its imports from. But 19 to 20% of copper imports within US happen from Mexico and Canada, where again, there is a tariff problem perhaps coming in. And we have seen that come in for prices. For today, though, it's going to be about the US non-farm payroll data. That is what the markets will focus on.
Absolutely. And now we are expecting that number to look weaker in December compared to November. Thank you for that, Manisha. With that, we'll take a break. On the other side, our special segment coming up with Lata. Today in Indianomics, she will be talking to a whole host of experts on what next for the microfinance sector. Have defaults peaked out?